Today, I want to walk you through a timeline of the various stages of life in terms of your wealth building and retirement planning, as well as give you certain milestones, age based milestones that occur along the way. Hi, I'm Mike Potter, and I'd like to welcome you to the True Wealth Financial Show, a show dedicated to providing you the information and inspiration to navigate financial decisions, intentionally build wealth, and retire with confidence. I appreciate you taking the time to tune in. Please feel free to like, share, and subscribe so you don't miss any future episodes. Additionally, you can find more information and resources on our website at truewealth.show. And now, let's get on to this week's episode. Welcome to another episode of the True Wealth Show. Thanks for taking the time to listen in. As always, I'm glad you're here. Today, I want to walk you through a timeline of the various stages of life in terms of your wealth building and retirement planning, as well as give you certain milestones, age-based milestones that occur along the way where you have the ability to do certain things based upon really IRS laws or various different laws that have taken place that have shaped the financial landscape from the United States perspective. So for most people, they start their financial lives at age 18, right? So at age 18 is the age of majority where you can then enter into contracts and agreements. So as a minor, you're really restricted. You can't have really your own accounts. You can't really enter into agreements or contracts. But generally in the United States, that changes at the age of 18 with really one exception. And so before I kind of get into all of those various different age-based milestones, I want to give you kind of an overarching, what's a good thing to be doing at a various different decade in life. So in your 20s, the main thing that you can focus on really is establishing good financial habits. Establishing good financial habits, right? So it's things like the basics of doing a budget, avoiding debt, building the muscles of saving, building the muscles of giving, building the mental aspect of being intentional with your money. Building good financial habits in your 20s will do wonders for you throughout your other decades. Essentially, what you're trying to do is do thyself no harm. What a lot of people do is they get into their 20s, they really go into a debt. They build a lifestyle that is unsustainable. And then a lot of people spend their 30s and their 40s kind of digging out of that. That's really what happened to us. We did a lot of dumb stuff in our 20s, and we spent the later part of our 20s and into our early 30s kind of rebuilding that. So don't do that. If you can, start off with good money habits, and you're doing a great job by listening to this show. As you transition into your 20s, this is a tough stage of life. Generally, by now, most people are having families, you're trying to build careers. And so what you want to try to do here from a financial perspective is prioritize, right? You only have so much money and you have a lot of competing goals. And that's really going to be the case for a couple of decades, really. But you want to maintain that intentionality. But you want to prioritize. This is a great thing done through money management, budgeting, right? Prioritize where each and every dollar is going to go because there's only so many and there's a whole bunch of, money monsters wanting to eat every one of those dollars. So this is where you really have to prioritize. As you go into your 40s, generally, the kids are starting to be a little bit older, a little bit more self-sufficient in terms of they're not little anymore. Your career, you're a little bit more established. Hopefully if you've done good things in your 20s and 30s, right, you're starting to see some of the benefits of delaying pleasure, working hard, being focused with your money. And so in this stage here, you just want to be purposeful, make it count. Not with your money, but also with your time. A lot of older people say it, and And I'm going to say it here, and you don't really appreciate it when you're in the middle of it, but some of those times you have with your kids and things like that are precious. And once they're gone, they are gone, right? So this is where you want to be purposeful. Take those vacations. Be intentional about them. Spend time with your family. Be purposeful with your money in that stage. As you transition into your 50s, generally now you kind of have a lot of the child rearing things behind. You might still have some college or some in high school, things like that. And this is where you want to maintain focused and intentionality. You want to be focused on what you're trying to achieve, because right now you're kind of in that transition of going from one stage into the next stage. And it's hard for a lot of people. But this is where you want to maintain intentionality, really getting focused on, wrapping up the current stage you're in and planning for the next stage, right? So this is the decade where most people make the most money in their career, generally speaking, because they're kind of at the peak of it. And you don't have all the pressures of a young marriage, a young kid. You're generally established in your career. And so this is the time where you can really put on the gas in terms of financially speaking for that next decade. In your 60s is when most people stop working, not all, but most. And so again, this is the decade where you're going to make your most amount of money in your life. So be intentional with it. As you get into your 60s, the main things here are to finish the career, finish your wealth building, and prepare for that next stage. So retirement transition is a very, very complex thing. It's kind of a scary thing. It's certainly an emotional thing, because this is the shift where you're going to turn off your income. So you've had 40 years of having an income, and essentially one day it's going to kind of go to zero, at least from an earned income perspective, when you quote unquote retire. And so you want to make sure that you're being intentional and planning for that. As you get into your 70s, what should you be focusing on? You should be focusing on enjoying your life and ideally giving back. At this point, you're kind of the sage, you're the expert, you're the elder, right? You're the one that everybody kind of looks up to. So take some time to enjoy that stage, but also kind of give back, help other people along the way from your wisdom, your knowledge, and your understanding. Now, what I want to do is transition into various specific age-based events that have a financial impact. As a person turns 18, they enter the age of majority. They're no longer a minor. And so this is when they can enter into contracts. They can have agreements. They can enter that cell phone agreement on their own. They can have bank accounts. They can have investment accounts. They can get loans. Hopefully they're not, but they can. But there's one type of loan that an 18-year-old cannot get, and that is a credit card. So in 2009, the CARD Act, essentially the Credit Card Accountability, Responsible, and Disclosure Act, prevented anyone under the age of 21 getting a credit card on their own. So that's, sadly, this just reflects the predatory nature of the credit card industry and companies. And so the federal government said, hey, you can't do this. These 18, 19, 20-year-old ones are not mentally aware of the damage that can be done with a credit card. And so we're going to prevent you from giving one to them unless they have a co-signer. So at the age of 21 is when a person could get a credit card if they are foolish enough to do so, in my opinion. Most of the time, when you're doing your FAFSA, filling that out, your parents' income and assets is a part of that. However, at the age of 23, or really some other conditions, a student is considered independent. So if they're age 23, if they're under that and married, if they have dependents where they're financially supporting other people, they are deemed as independent, which generally lowers that expected family contribution and therefore might help get grants, scholarships, and other financial aid. From the age 23 all the way through our 30s, all the way through our 40s, really there's no other age-based milestones that apply. The next milestone is at the age of 50. So at age 50, you can begin contributing to retirement accounts with what they call a catch-up provision. So right now in 2023, an individual can contribute $6,500 to an IRA, whether Roth or traditional. However, at the age of 50, you get the ability to contribute another extra $1,000 to that individual retirement account. Additionally, defined contribution plans, 401ks, 403bs, TSPs, things like that. In 2023, an individual can contribute $22,500 to that 401k, 403b account. However, at age 50, you get a catch-up provision which allows you to contribute an additional $7,500. So a person over 50 can contribute $30,000 per year to their retirement accounts, giving you either deferred tax growth or tax-free growth if it is a Roth plan. The next age-based milestone occurs at the age of 55. At age 55, you then have the catch-up provisions for health savings accounts. So health savings accounts, unlike the retirement accounts, have different ages associated with them. So a couple rules on this is, one, you have to be in a high deductible health insurance plan. So a high deductible, it sets a limit for what that deductible is. And if you're over that, then you can then contribute to a health savings account. It's essentially like a retirement account for health medical expenses. So an individual, again, 2023, can contribute $3,850 to an HSA. But at the age of 55, they can contribute an additional $1,000 per person. A family in 2023 can contribute $7,750. That's their limit, basically double the single rate. And for each spouse that's over 55, they can contribute $1,000. So if one spouse is over 55, you can contribute an extra $1,000. But if both spouses are over 55, then you can contribute $2,000 extra on top of that for a total of $9,752. The next age-based milestone on the timeline of our financial journey is that of age 55. At 55, some, and I caveat that, some employer qualified plans, so think 401k, 403b, things like that, will allow you to have penalty-free distributions at the age of 55. There's a couple caveats, though. One, your plan has to allow it. It has to be the plan from your last employer. So you'd have to leave. It only is applicable if you leave your employer. You can't stay there and work. Some plans have in-service distributions, but that's a different thing than we're talking about here. The money has to stay in that plan, so you can't roll it over. You can't leave your job, take that money and roll it to a rollover IRA or a different 401k. But ironically, you can get another job. So there's a handful of rules along this of how to do it. Again, this is where good planning from a retirement perspective comes in. If you're in your early 50s and you're looking to leave, retire, quote unquote, early, if you will, that could be one of the ways you can get access to some of your retirement savings at the age of 55. The next milestone after that is, you've probably heard of this one, which is 59 and a half. Why half? I don't know. But 59 and a half is when you can get penalty-free distributions from your retirement plans, 401k, 403b, TSP, etc. Generally, there's still taxes involved. So depending on how you contributed, if it's a tax deferred, when you pull money out, there's still a tax element to it, but there's no penalty for it. If you pull out money from a retirement account early, let's say in your 20s, 30s, early 50s, you may have tax consequences And there's a penalty, a 10% penalty on the entire distribution if you take it out early. There's a couple exceptions to that: education, buying your first home, things like that. But the general rule is if you take it out early, you're penalized. Well, at age 59 and a half, the penalties for those retirement distributions goes away. 59 and a half is also the penalty-free distribution age for a life insurance policy that has become a MEC, a modified endowment contract. Won't get into a whole lot of the details here, but essentially they're in insurance, life insurance. We'll talk about more of this in the future. There are savings elements and even investment elements inside of life insurance policies. What some people have done is they've bought a life insurance policy, but have really used it for an investment aspect of it. And the IRS says, hey, they have different taxation rules on life insurance and investments. And so this is kind of a game setter. So if an insurance policy gets too much money put into the savings and investment side of it, it becomes what's called a MEC, a modified endowment contract, where then it doesn't follow the life insurance rules. It follows the investment rules, where you would have those consequences of taxes taken out, but there's also a penalty, tax penalty, 10% if you take it out early. So at age 60 is when your Social Security indexing stops. So we'll go into the whole way Social Security is calculated in a future episode. But for now, essentially, the concept is you have worked for all of these years, generally close to 40, at least 35 in most cases, and you have wages that are, 20, 30, 40 years ago. Well, comparing that to expenses today or the inflation costs today. So what Social Security has to do is they have to index. They create an index, and they take that index from your current money that you made in the year of maybe 1980, and they kind of bring it up to current dollars 2023. Well, that index is set and fixed the year you become 60. So whatever year you become 60, that index then is set for all your ages prior to that, 59, 58, 57, all the way back to when you first started working, maybe at 14. And so they take your actual wages in the year earned, times it by this index, and then they bring up all of their current, former wages to current dollars. So I say all that to say there's no extra boost after you turn 60. So after 60, you get an index factor of 1. So whatever you make is your index factor. You don't get a boost anymore. So even though you might not be taking Social Security till you're 70, your indexing boost stops at age 60. And what that means is after you turn 60 and those numbers are put out, you can start to have some good perspective and projections as to what your retirement benefits are going to be. And you can start to make some planning decisions. Do I want to take it early? Do I want to take it at full retirement age? Do I want to delay it? And how it works in with all of your other retirement income. At age 60 is also when Social Security spousal survivor benefits start. So this is survivor benefits. So this means if you had a spouse who was contributing to Social Security and they passed away at age 60, generally is when you can begin getting survivor benefits from Social Security Administration from a benefits perspective. You can get them earlier than that under certain conditions, but the general rule is at age 60, everybody can begin getting them. The next milestone is age 62. So age 62 is when a person who is qualified for Social Security benefits, they're either a fully insured worker or they're currently insured worker. There's some nuances there. They can apply for and begin receiving Social Security retirement benefits. For most people, really for all people, they are fully insured. They have a full retirement age of either 66 and some months or 67. Most are going to be 67 at this point if you haven't already applied for Social Security or are not already there. But if you want to, you can take it early. However, there is a reduction for each early year you take it, really for each month you take it, before age 67 or 66 and however many months. So the first 3 years you take it early, you take a reduction of benefits of 6.66%. For years 4 and 5, so if you take it when you're 62 or 63, there's an additional 5% reduction. So something, again, that goes into that retirement income planning. At age 62, a spouse can also apply for Social Security benefits as well. As always, there's a couple of rules associated with this. The primary one being that the primary worker has to also have filed for retirement benefits. So it's a scenario that generally goes like this. Let's say you have one spouse who's the breadwinner, one spouse who stayed home, raised the kids, took care of the house, supported that other worker, etc. Well, that person they're not eligible for Social Security benefits because they never paid into the system, that supporting spouse. So there's a provision in the tax code that allows for a supportive spouse to get up to half of their spouse's, the primary worker's, retirement, Social Security retirement benefits. But they have to additionally be retired as well, at least drawing benefits. At age 62 also is when a person is eligible to get a reversed mortgage. So you know what a mortgage is? You borrow money and then you pay it down over time. Well, a reverse mortgage works the opposite. It's when you have a paid-for house and you get payments as income coming into your house. And then when you pass on, the house is sold generally by the heirs and the mortgage is repaid back. Well, you're only eligible for that if you're age 62. So it's another way to get potentially retirement income using your house equity as income in. Age 65 is when you are then eligible, or I should say is when everyone is eligible for Medicare. It's the age in which you can apply to receive Medicare. What most people also don't realize is they think, hey, I paid into this system. It's free health insurance for when I'm old, but that is not the case. There is still premiums with Medicare. Medicare Part B and D both have premiums, insurance premiums associated with it. Medicare Part A, B, C, and D all have deductibles associated with them. And Medicare B, C, and D have coinsurance where you pay a portion and Medicare pays a portion. So it is by no means free, but it is compulsory, meaning you have to sign up for it. And you sign up for it, most people, generally at the age of 65. The next age-based milestone is that of your full retirement age from a Social Security perspective. So if you were born 1960 or later, your full retirement age, which is when you get your full retirement benefit, it's no longer reduced for taking it early, is age 67. If you're born between 1954 and 1959, it is 66 and so many months. So 54, it's 2 months, 55, it's 4 months, 56, it's 6 months, etc. Increments by 2 months by each year. And then 1960 forward, it's 67. So that is your full retirement age. That is the number at which all of your benefits are calculated off of. They're either reduced for taking it early or added for delaying them later. Speaking of delaying them later, age 70 is when you stop getting increments or increases for delaying it. So if you're eligible for Social Security at age 67, but you don't take it either because you're working or because you have other income streams or you just don't need it or you've chosen to delay it, you get an 8% annual increase each year for delaying it, which is very nice. So age 67, you don't take it. Age 68, you don't take it. Age 69, you don't take it. For each one of those years, you get an 8% increase of the benefit. But at age 70, it stops. So at age 70 is when you would want to start your Social Security if you have delayed it because there's no benefit and delaying it thereafter. Age 73 is the next milestone. So at age 73 is what begins what's called required minimum distributions, or RMDs for short, required minimum distributions. So a required minimum distribution is the idea that for so long, the government has allowed you to delay, to put money into retirement and delay paying taxes for the sole benefit of saving for your retirement. Well, now at age 73, the government says, hey, we've delayed this tax payment long enough. We want our income. So they begin forcing you to take money out of your retirement plans, therefore creating a taxable event. So when you take money out, a portion of it goes to an IRS and some of it comes to you, splitting it off. So they get their tax revenue. And so up till 73, you cannot take it out if you don't need the money, but thereafter, you are forced to take it out. And it's so much per year based upon your life expectancy and the account balance. There's like everything formulas involved. It used to be that age was 70 and a half. Again, I don't know why the half. That made everything really confusing. They changed it to 72. But for those turning 73 this year and beyond, it's going to be 73. The Secure Act 2.0 has already built in provisions to make it 74 and 75 in the 2030s decade, but that's a ways away. For right now, essentially, you either have already taken them because you're 72 or you're turning 73 and you have to take it this year. And you want to take them because if you don't take them and you get audited, it is up to a 50% penalty. So you have to take the money out if you get caught. You have to pay the tax. You have to take the money, and you're penalized up to 50%. That is quite a hefty penalty for not taking it. So this is definitely something you want to get right. And that is the last age-based milestone from an adult perspective. Now, obviously, this was very confusing. There's a lot of age-based milestones, especially as you get into those later years and begin planning retirement. So to make this easy for you, I have made a one-page PDF that has the age as well as the name and a little summary of what this event is. You can find it at www.truewealth.show and then click the Resources tab. There you can download the age-based milestone timeline PDF, and you can have it for your reference. And that is your micro action for the week, is to go to truewealth.show, to the Resources tab, and download this PDF for your reference for future planning. I hope this is helpful for you. Thanks again for taking the time to listen in. And until next time, I hope you have a great day. Thanks again for taking the time to watch or listen this week's episode of the True Wealth Financial Show. I encourage you to like, share, subscribe so you don't miss any future episodes. Additionally, you can go to www.truewealth.show for more information and resources. One final note as we wrap up today's show. I hope the information that you were provided was helpful and valuable, but I want to remind you that it's really for educational purposes only. Prior to making any decisions or taking any actions, I would strongly encourage you to talk to your legal, tax, estate, or financial advisor who's familiar with the circumstances of your situation. Until next time, I hope you have a great day.